Welcome to the March Market Thoughts video. My name is Maria Considine King, and I'm joined by Brad McMillan, Chief Investment Officer at Commonwealth Financial Network. Brad, on March 1st, the Consumer Sentiment Index was released, indicating that consumers are feeling fairly confident about their financial health. And this is somewhat in line with strong auto sales in February and better than expected home sales in January. Do you expect continued strength in these sectors going forward?
I'll tell you, Maria, one of the really encouraging things about the economy so far year to date has been the strength of both consumer sentiment and consumer spending. You know, it's remained at relatively strong levels and by recent history. It's still below where historically it's been in an expansion, so we've got some room to make up here, but nonetheless it is encouraging, and I think a big part of what is driving that is the recovery in wealth for the average consumer from the housing market. Because of that, a lot of people have been, I won't say sitting on their hands, but spending growth has been subdued, and that's actually starting to come back. You're starting to see the pent-up demand for autos really kick in. They've been performing very strongly, and they're expected to continue to do so. The housing market recovery is now becoming mainstream information, and that in turn will continue to change the psychology, which should further boost confidence. Another significant positive factor has been the strong performance of the stock market. There's a perception that if the stock market is doing well, the economy must be doing well, and there's a lot of truth to that. But it also means we're vulnerable on the downside if something should happen. But I think on the whole, as I've said, the economy is recovering. That's translating into the consumer, and that's what's driving most of the improvement in confidence.
At the end of February, the Dow was up almost 1.5%, a bit of a surprise given upcoming sequestration and expected across-the-board spending cuts. Have the markets baked in their expectations for the impact of those cuts, or are the cuts not as bad as we thought they might be?
I think there's a couple of things going on with that. In the first case, the sequestration is nothing like as bad as the fiscal cliff at the end of last year would have been. Estimates of the impact are about 0.5% of GDP, which is not nothing. But at the same time, we're growing at a rate that should allow us to overcome that. Second of all, this was hardly a surprise. This has been telegraphed, this has been talked about. Everybody knew several weeks ago there wasn't going to be a deal. So consequently, you have a situation where there's no surprise, the impact is relatively muted. Small surprise that things are continuing to do well.
A recent post in your blog, The Independent Market Observer, mused on current market valuations and teased apart some of the things to consider in thinking about whether upward market momentum would continue. Would you share some of your thoughts here?
We're actually at a very interesting time with the market. We see the market going up, and then if something happens, for example, the Italian election, it got knocked hard, and then it came back. We're approaching what's called a resistance level, which would be the previous all-time highs. We're not quite there yet, but we're getting there. And there is a real sense that if, in fact, we can break that resistance level, the market will continue to run. However, there's a tendency, as we start to get close to a resistance level, to slow down, bounce around, and even reverse. And we're seeing some signs of that as well. So it's a tough call to make. But in the next couple of weeks, we should have a little bit better idea where this is going to go.
Iran and North Korea are unstable areas that are simmering on the edge of investors' consciousness right now. Have international markets reacted to conditions in those areas, and how would you expect U.S. markets to react if something flared up?
Well, there are a couple of different things going on. North Korea, as we know, just had another nuclear test. Syria and Iran and the Middle East. When has there not been problems in the Middle East in my lifetime? So I think to some extent the market has already internalized a lot of this, at least in the U.S. I do believe emerging markets are being affected by the increased uncertainty, and I expect to see that continue. But here in the U.S., in some respects, we actually benefit from that. We benefit from a flight to safety. We benefit from the highlighting that the U.S. is a stable environment. So, you know, should something happen, certainly, as I mentioned earlier, we're at a very sensitive point for the market. It could affect the U.S. markets, but on the whole, we are relatively well positioned compared to the rest of the world, and I expect that to continue.
Thank you, Brad.
Thank you, Maria.
And thank you. Please join us next month for the Market Thoughts video.